What's up, traders, and welcome to another installment of the Market Barometrix Technical Analysis series. I'm your host, Neil, and in today's video, we're going to be talking about moving averages. Now, moving averages are a technical indicator that are going to help us to identify the prevailing price trend, as well as potential changes in the price trend across different time frames. In addition, it's going to help us identify attractive entry and exit signals. Without further ado, let's jump in and learn a little bit more about moving averages. Alright, friendos, a moving average is a commonly used technical indicator used to help smooth out the noise, aka volatility, exhibited by short-term price movements. They help to visualize the overarching price trend and offer potential areas of support and resistance. In addition to that, they're going to help us confirm reversals in the trend. And we'll talk about how to use moving averages in our trading here in just a minute. But for now, there are two main types of moving averages. You have simple moving averages and exponential moving averages. So broadly, a moving average just takes a subset of the most recent price data, typically 9 days, 50 days, or 200 days. It's going to add all those close prices together and divide them by the total number of days. The resulting number is going to give you a data point for that moving average on that day. Exponential moving averages and weighted moving averages are calculated very similarly to simple moving averages, only they give more importance to the more recent readings. The math for each is a little bit different, but generally just know that exponential moving averages and weighted moving averages are going to be more reactive to recent price movement. So let's pop over to the Market Barometer to get a closer look at this in action. So if I come grab my date range tool here, and say we wanted to calculate a 9-day simple moving average, we would take the close prices of these 9 days, we would add them together, and we would divide by 9. The resulting number would give us the most recent data point for the 9-day moving average line. And so that's why this is called a moving average, because the previous day it would have added together these 9 bars, and before that, these 9 bars. So every day this is calculated again, and a new data point is added each day. When you connect these series of data points, you end up with a moving average line. So let me get that called up here. So simple moving average, and this is the 9-day that we have right now. And you can see that the 9-day is fairly reactive to price because it's taking the average of the most recent 9 periods. So you can see this blue line tracking price. This is the 9-day moving average line. Now the 9-day moving average is going to be an indicator of the short-term trend because we're taking a small number of periods. And in addition to that, when I'm looking at short-term trends, I like to use the exponential moving average because that's going to give more weight to the most recent days. And in a fast-moving market, the exponential moving average is going to do a little bit better of a job of reacting to the most recent price movement. So again, moving averages are a great indicator of the overall prevailing trend. So you can see right here in late August, price was above the 9-day EMA and was pretty clearly in an uptrend, right? And with price above the 9-day exponential moving average, it's confirming that the short-term trend is up. So I mentioned earlier that moving averages can indicate to us, buy and sell signals. Now that generally happens whenever price crosses over a moving average line. So right now we're still looking at the 9-day moving average, and we were in an uptrend in August. But then in early September, price crossed below the 9-day. Right about here. So price crossing below a moving average line might be interpreted as a sell signal. So you can see this short-term uptrend rolling over as price moves below the 9-day EMA, at which point price enters a new short-term downtrend. Not long after, price starts to bump back up against the 9-day EMA and finds it at first as a point of resistance. But eventually it breaks out to the upside, forming a new short-term uptrend. And you can see that, even during this short-term uptrend, price comes back down towards the 9-day EMA, looking for a moment like it might break through to the downside, but then price turns back up and resumes its position above the 9-day EMA. So this ended up being a false breakdown. So generally, whenever price moves above or below a moving average line, I look for 2 decisive closes on the other side of that moving average line to confirm to me that the trend has changed. Going back to the beginning of October here, you can see the same thing happening. Price kind of oscillating above and below the 9-day EMA. But eventually we see 2 decisive closes on October 8th and October 9th, confirming to us that the trend is changing and leading to a move higher in price. So far, we've looked at the 9-day exponential moving average and how price trends around the 9-day EMA, indicating to us the short-term trend and changes in the short-term trend. Now, where things start to get really interesting is whenever you start adding moving averages of different time frames. So whereas the 9-day EMA gave us a good idea of the short-term trend, the 50-day and 200-day moving averages are going to indicate to us the intermediate term and long-term trends. When we get all 3 of these things happening at the same time, we can look at the changing trends across different time frames. Further, just as price moving above or below a moving average can give us a entry or exit signal, whenever moving averages of different time frames cross over each other, it gives us an even more substantial indication of a changing trend, and these are known as moving average crossovers. So that all sounds good in theory. Let's check it out in practice. Alright, so we already had the 9-day exponential moving average. I just added the 50-day simple moving average, and I'll go ahead and add the 200-day simple moving average as well, but I'll let you guys watch me do it this time. So we're gonna go moving average. It defaults to the 9-day moving average here in the Market Barometer, but if you just click on the 3 dots here, say more, go to settings, you can change the length to whatever you want. But I like the 9, 50, and 200-day moving averages. So now we have the 9-day tracking price fairly closely. The 50-day is not quite as reactive and is a little more flat, and the 200-day is even less reactive. In fact, right now you can see that we are way down here with the 200-day. So one more thing to mention is that, I personally like to use the 9-day exponential moving average because in volatile markets, whenever I'm looking at short-term trends, it's going to be more reactive to the most recent price movements. Whereas the 50-day and 200-day, the intermediate term and long-term trend indicators, I don't want them to be quite as reactive to price because I'm looking for things that are happening on a longer scale, right? So my personal preference, 9-day exponential moving average, 50-day and 200-day simple moving averages. But this is totally up to you and it's completely customizable here in the Market Barometer. So now we have all 3 of our moving averages here. We have the 9, 50, and 200 days. So we can now discuss the trend and price momentum along various time frames. So we already talked about the 9-day EMA. We were in a short-term uptrend here in August. It rolled into a short-term downtrend through September and then turned back into an uptrend around early October. Looking at the 50-day moving average here, you have price above the 50-day for most of August and September. Mid-September, price crosses below the 50-day around the same time that the 9-day exponential moving average crosses below the 50-day. So this was a pretty substantial sell signal here with price and the 9-day both moving below the 50-day moving average. Price and the 9-day don't spend a whole lot of time below the 50-day though, as they both turn back above it here not long after. So the short-term and intermediate term trends as measured by the 9-day and 50-day moving averages are basically just fluctuating up and down over this, 3-month period or so. But put that in the context of the long-term trend. The 200-day moving average is all the way down here. Price, the 9-day, and the 50-day moving averages are all trending above the 200-day moving average during this entire time frame. So that tells us that the long-term trend is bullish, is positive this whole time. Whereas the short-term and intermediate-term trends are kind of fluctuating. So towards the end of the chart, the most recent readings, we see price and the 9-day recently moved back above the 50-day. So as of today, which is October 23rd, 2020, we are in a fully bullish technical formation. And by that, I mean price is above the 9-day, is above the 50-day, is above the 200-day. So as far as the relative positioning of price and the moving averages, we couldn't be any more bullish than we are right now. In my opinion, the most important information that we gather from performing this kind of analysis is what is the implications as far as our investment decisions. So there's a lot going on here, and depending on your style of trading and investing, there's different pieces of information that you could have gained from doing this analysis. For example, if you're a short-term trader, you could be focusing on price, the 9-day, and the 50-day. You might have had a short-term sell signal here where price crossed below the 9-day. And again, you might have had a short-term buy signal here where price moved above the 9-day EMA. If you're an intermediate term kind of swing trader, which personally I like to do a lot of swing trades with options, I'd be looking at 9-day and 50-day crosses as well as how price is reacting around those times. So this would have been a pretty major inflection point for me as a swing trader, with the 9-day crossing below the 50-day and price crossing below the 50-day around the same time. Now that could be interpreted as a sell signal, although it happened on this price gap here, which would have made me nervous and probably would have stopped me from entering a short trade, which would have ended up being the right call at that time, as price ended up moving back up not long after. But then, this area here where price is kind of oscillating above and below the 9-day until finally breaking out and shooting above the 50-day, price then comes back down to the 50-day around the same time as the 9-day exponential moving average is catching up. So, I'm talking about this area here. This would have been an interesting entry point around here, probably on this second close above the 9-day EMA. I would have entered a bullish position here in either the short term or the intermediate term. And I think that would be a pretty favorable entry point with a high probability of success. Now, as far as signals for long-term investments, you can see that over this entire date range, the long-term trend is bullish because price, the 9-day, and the 50-day are all above the 200-day moving average the whole time. But if I was looking to enter a long-term position in September, as price trended down and started to move towards the 200-day moving average, I would have been paying close attention around that time if I was looking to enter a new long-term position here, because the 200-day moving average is typically a pretty solid point of either support or resistance. You can see here that towards the beginning of September, price was very extended above the 200-day moving average, to the tune of like 20% above the 200-day. So typically, whenever price diverges from the 200-day moving average to this extent, it's more likely that price is gonna either consolidate or trend back down towards the 200-day moving average before continuing its move higher. And that's exactly what ends up happening. So price ends up trending back down, moves below the 9-day and 50-day moving averages, gets all the way back down to the 200-day moving average here on September 24th. Now, this would have been an interesting time to be watching, because if price continued and broke below the 200-day moving average, that would be a very bearish long-term signal. But what ends up happening is price finds the 200-day moving average as support and bounces off of it. So you might interpret this bounce off the 200-day as an entry signal. Personally, I'd probably be looking for a short-term entry signal in addition to this bounce off the 200-day moving average, which we end up getting about a week and a half later. So price bounces back up to the 9-day EMA, oscillates above and below it a few times, but then again, this short-term signal here where we get two closes above the 9-day EMA would have given me the confirmation and the confidence I needed to enter a new long-term position. Because in essence, we have this long-term entry signal here, but things happen more slowly on a long-term scale like this. So right after that, whenever we have this short-term entry signal, that to me is providing confirmation that the change in the long-term trend is really taking hold. If you needed even more confirmation and wanted to be even more confident about the change in the direction of the long-term trend, you might have waited until the 9-day crossed back over the 50-day here. Because at this point, we enter a period where we're in a fully bullish technical formation, meaning that price is above the 9-day, is above the 50-day, is above the 200-day. The trend is up on all time frames. And this would be a very attractive, very high probability place to enter a new long-term position. So there you go, folks, a quick look at moving averages, which are another technical indicator that are going to help us to identify the trend, changes in the trend, and entry and exit signals around those changes in the trend. We typically use the 9-day exponential moving average, the 50-day simple moving average, and the 200-day simple moving average as ways to identify the short, intermediate, and long-term trends, respectively. So if you guys like this video, don't forget to subscribe to the channel, hit that like button, comments down below, and until next time, thanks for tuning in. We'll see you guys in the next video.